Now, I know all of that was fun. Any questions?
So does your book include this update?
It does. It includes the update. A lot of it. But by the way, you call it advertising, but it's a great book. We have charts, for example, to help you determine if it's a covered opinion, because it's very complicated and it's a decision tree, and you're going to go yes, no, and it has red boxes when there's danger and green boxes when it's clear. We give you sample forms of opinion letters to use. One of the things, nobody I know has ever written a covered opinion because it's virtually impossible. But we tell you how to downgrade it to something called a reliance opinion and even a limited scope opinion. And we give you samples on how to do this. And this is the kind of thing that I think you have to talk to your colleagues about. But there are lots of charts, lots of information. The book has a whole chapter on reportable transactions. And as you may know, if your client's involved with a reportable transaction, it's almost a death sentence from the IRS because you have to file a form with the IRS which basically says, come and get me, I'm a potential tax cheat. And you have to know, your client's not going to know what is a reportable transaction. You have to know what is a reportable transaction. And the rules state if there's any broad way that the transaction described as a reportable transaction could apply to your circumstance, you must assume it does. So even if you go to Greenberg Traurig and you go to Ackerman and you go to Milbank Tweed and they all say, no, 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 it's not a reportable transaction, that may not be good enough, and your client can automatically face a fine for failure to file of $200,000. And if she does, guess who she's going to expect to pay it? It's you. One critical element, and we have a chapter on penalties in our book, about there are over 100 penalties in the Internal Revenue Code now, over 100. The critical ones for you are essentially section 6662. I don't think anybody here needs to read about how you get a penalty if you have an unregistered alcoholic still, for example. But the 6662 are the underpayment of tax penalties because of negligence or because you have failed to file a regulation or even a revenue ruling. If you have an undervaluation matter on a gift tax return or an overvaluation on an income tax return, and how those rules are, and they're very, very complicated. I think Mitchell and I explained it very well, but you have to know those because you have to tell your client about penalties reasonably likely to apply. And if you don't know what they are, you can't say, I told her. Well, we know you don't even know the rules. And to try to, again, we've learned with so many things that it's not the sin, it's the cover up later, and yet you're in such a panic that you want to do the, oh yeah, I knew all about, and then someday they find an email where you say, what are you talking about, 6662D? What is that all about? Oh, really? You knew all about the penalties? Then why were you asking that question? You're going to have programs at your firm about the penalties, programs about the affirmative duties, and the prohibited activity under Circular 230. And you're going to have to make sure that you have methods. And look poor Joe Paterno. Joe Paterno followed the rules, and yet he has been fired. Now, you could say, well, that's good for him or bad for him or whatever. But at a minimum, you've got to make sure you follow the rules. So that's my best advice to you. Any other questions? Yes, sir.
Just going back to the 2009 ruling on the self-settled trust, was the settlor in that case an Alaska resident, and do you think it matters if the settlor is a resident of a state that doesn't allow it?
Well, that's a great question. The question is that 2009 44002 private letter ruling where the IRS said it would not be includable in his estate. He was an Alaskan. Did that matter? The answer, I am confident, is no. Now, there's an article by Mitch Gans, my brother, Gideon Rothschild, and me that appeared in the January 2010 issue of Estate Planning magazine. I think it's cited probably in that little article by my brother and me. And we do a complete discussion of this about, does it matter where you live? And we're confident the answer is no. Section 273B of the Restatement of Conflict of Law says the self-settled protection isn't determined by the grantor's domicile. It's determined by the law that governs the trust, and this is an Alaska trust. And the ruling seems to be very clear. And remember, the IRS has issued other rulings. For example, the one, and I think it may have been Bermuda, where somebody created a Bermuda trust, two brothers, and it's cited in that article, from America, and yet the IRS said it's not includable in their estate. So the answer appears to be there's also Revenue Ruling 76-103, 77-378, and Revenue Ruling 2004-64, which I talked so much about earlier, all of which indicate it's the law that governs the trust, and that's consistent with the restatement of Conflict of Laws, Section 273B. So, but I urge you, if you're going to get involved with self-settled trusts, I mean, if you're doing it for husband and wife, you're not really in that world. But if you're going to do a self-settled trust for a client or for yourself, please read that article. And it explains the laws of all the states. Florida hadn't passed it yet, but all the states like Delaware and Wyoming on why they do not produce the result other than the state of Nevada. And we give you, again, hints on how to do it. For example, again, allow someone to remove the grantor as a beneficiary before she dies, so 2036 and 2038 can't apply. So it's a very comprehensive article that we wrote, and I urge you to read it. And again, to me, you ought to be able to just knock the sock off the ball for the rest of this year and next year by getting everybody you know to consider using their $5 million exemption, especially a married couple, even in a second marriage situation. So if Diana puts in $5 million in trust for me, and I put $5 million in trust for her, she hasn't lost anything, I haven't lost anything, because the trust that I've created for her is for Diana and her family. The one she creates for me is for me and my family. So again, you've got to do this for yourself. And one of the reasons, again, why do you do it for yourself? For the asset protection you'll get. Because if somebody comes in and says, well, we're going to go after your self-settled trust, they can't, because you weren't trying to defraud a creditor. You were trying to use this once-ever opportunity to get $5 million. Now, let me mention two other things when you create the trusts. Number one, you're going to have to put in that for the first year at least, the only distributee is a grandchild. Wait a second. The trust that Diana creates for me says this trust is for Jonathan and his descendants, but for the first year, the only distributions can be made to his granddaughter, Mia. Let me tell you why. Remember, these laws expire at the end of next year, and these laws state that after they expire, the Internal Revenue Code will be applied as though those laws had never been enacted. Now, if the 2001 and the 2010 Acts had never been enacted, how big would the GST exemption be? $1.4 million approximately. Yet Diana has put $5 million in trust for me and allocated her GST exemption to it. Well, if that law literally applies, the IRS, beginning in 2013, will say to me, hey, Jonathan, this trust that Diana created for you, it's not entirely GST exempt. Only about a third of it is GST exempt, because only 1.4 now applies, because we forget about the $5 million exemption. But if the only beneficiary of the trust initially was my granddaughter, then that transfer is a direct skip, which means until the money gets beyond my granddaughter, there can't be any generation skipping tax. So part would be permanently GST exempt, but at least we know when my kids die, and up until the time my granddaughter dies, we're not going to have any GST tax. So that's one thing. And another, in your trust, put in a provision for disclaimer, because maybe the law will change by what the supercommittee does, by a law passed next year, which means that it was wrong to create this trust, or it's the wrong form. Well, if Diana puts in the trust that she creates for me and my descendants, that Jonathan can disclaim any gift made to this trust, and upon such disclaimer, it reverts back to Diana, we'll have 9 months in effect to undo it. By the way, if you do wealth transfer planning, and you go to irrevocable trust, and you go to installment sales to grantor trust, you will find language that I've put in where you can name a beneficiary of the trust as the person who can disclaim on behalf of the trust. Please build that into your documents. Make sure, because we can't be certain, and maybe you're acting a little quickly because you want to get it done before the end of this year, that you have the disclaimer escape hatch out of it. Any other questions? Larry.
You have here the Obama administration proposals.
Yeah, the Obama administration proposals are very far-reaching. He wants the estate tax exemption down to 3.5 and the gift tax exemption down to $1 million. You know, who knows if he'll get his way. Another thing that he wants to do, and it's perhaps one of the most far-reaching, is he wants to eliminate discounts and valuation on things like family partnerships. You would look through every entity and see whether or not that asset is being currently used in an active trade or business operated by that entity, the limited partnership. So your marketable securities, your bonds, the blank real estate, vacant real estate, you're going to get no discount at all with respect to those. It basically kills family partnerships. Even with respect to closely held business, if the family collectively, this includes your step-grandson-in-law, if collectively the family owns 50% or more, no lack of control or minority discount, even if you've only held ever a minority discount and you hate your step-grandson-in-law. There's no exception, no special rule. One of the other things that the Obama administration would do is that they would allow the GST exemption to be in effect only for 90 years. So, for example, this trust that Diana is creating for me would only exempt it from GST tax for 90 years. And because my granddaughter is only 7, if she lived to 97, there never would have been any GST exemption to begin with. Now, this is something that really will be important to your clients who have grandchildren and great-grandchildren. Because right now, you can essentially create a perpetual trust. It's 360 years in Florida, it's essentially perpetual, or other states, and exempt it forever from GST tax. But if that proposal from the Obama administration comes down, and it's not a matter of tax collection, it's one of perception to the poor that we're not letting the rich avoid tax forever, you better have your clients do something about it. And here's one thought. Let's suppose that this law passes, and a client comes in to see you and says, gee, I read in the newspaper that now I can only make a trust exempt from tax for 90 years. Yeah, that's the law. How long have you known about this proposal? Oh, I only found out the day it was enacted. Right. If the client finds out that you knew and you didn't send them a note, maybe you have a very unhappy client. I don't think you can be sued for it. I don't think you have an affirmative duty unless you promised. But again, sending out a note to your clients to say, look, this is a great time to do it because of the current law, which is going to change. But on top of that, because the Obama proposals, for example, maybe your client wants to transfer, something in a limited partnership or something with a discount which wouldn't apply anymore, but also for older clients who have grandkids and great-kids, they love them so much that if you haven't given them the opportunity, let them turn you down. Let them say, no, I'm not going to bother. Fine, but you would have at least told them. I would send out at least a flyer telling them about the proposed Obama administration changes, which reinforces the need to use your exemption right now. And if you're married, the couple is going to have it for the rest of their lives. It's not like they're giving it up. What if I need the money? If you need the money, it's there for you. And Diana's going to give me a power of appointment so I can have some control. I'm going to give her some. Now, if it's a first marriage situation, and say the husband dies and he continues the trust for the wife, he can't give her a power of appointment. Why? Because of Section 2038. It's not a matter of creditors' rights, Section 2038. But the wife could benefit from it for the rest of her life, even from the trust she's created, if it's created where? In Alaska, that's right. By the way, you don't have to start the trust in Alaska. You could have Florida trust. And let's say when I die, I want to continue the trust for Diana. What I would do is I would create a $10 trust in Alaska and then appoint the power of appointment. I would appoint the assets in this trust Diana has created for me over to that $10 Alaska trust. So you don't have to start in Alaska unless it's going to be self-settled from inception. But if it's for a couple at the end, remember, when the husband gets ready to execute his power of appointment, you're going to have a $10 trust in Alaska to whom he will appoint the property. So that's what you're going to do. Thank you very much for having me.